Please refer to page 3. We have discussed accounting for subsidiary, accounting for associate, joint venture, and joint arrangement. The next topic we're going to discuss will be changes to the parent interest in subsidiary. This is a common topic for Module 11. Make sure you understand this topic very well. We've covered the basic accounting for subsidiary, associate, and joint arrangement. Subsidiary is a topic that definitely you'll see in the exam. You have to pay attention on this, how to account for subsidiary. Associate is a likely topic. Now we're going to look at complex issue on group accounting. The first issue we're going to look at is changes in parent interest in subsidiary. Take for example, before that we have 30%, we increase 50% to 80%. Another type of changes may be from 80% plus 10% equals to 90%. And the third type of changes may be 80% minus 20% equals to 60%. And the last type of changes, 80% minus 55% equals to 25%. There are two types of changes generally. One is increase, the other is decrease. When we say increase, means step acquisitions or piecemeal acquisitions. Another type of changes is disposable of share. For accounting treatments, there's only three types of treatments. From 30 to 80, that means from no control to control. Gain of control, we have to do a consolidations in accordance to FRS 10. Another type of change, before that is 80, now it's 90%. 80 to 90, do we have more or less control? The same control. Because 80% give us 100% control, 90% also give us 100% control. No change in control. Before that is 80%, give us 100% control. After that is 60%, it still give us 100% control. There's no change in control. Control unaffected. The ownership of the parent and NCI are subject to the adjustment. For this type of change, because this as equity transactions between the parent and the NCI, we adjust NCI. The last type of change, before that 80%, 100% control, 25%, 0% control. 100% to 0% control means loss of control. If it's loss of control, we have to do a deconsolidations. Please refer to page 23. When there's a change of ownership in subsidiary, there are a couple of factors to consider. First factors to consider is how this affects preparations of the consolidated financial statements. How do we calculate the gain or loss, or we call this as the differences on the change. When we talk about changes in ownership of subsidiary, these are the two factors that we must consider. How this affects the preparations of consolidated financial statements, how do we calculate the gain or loss on the change. We look at the first factor first. Different scenario. For example, the first scenario here is before that AB owned 30%, after that AB increased by 50% equals to 80%. The second example is before that AB owned 80%, AB add 10% equals to 90%. How this affects statement of profit and loss and statement of financial position. I'm doing this now. The effects on consolidated financial statements. Case 1. For example, our year end is 31st December 2016. 1st Jan 2016. Start of the year, end of last year. AB investment in XY. The start of the year, we have 30%. On 1st March 2006, AB acquire another 50% equals to 80%. At the year end, this will be 80%. For profit and loss, is for 1 year, 12 months. This is the date of the change. In this case, it's gain of control. The first 2 months, because it's only 30%, if it's 30%, we consider this as an associate. Associate means 30% share of profit or loss for these 2 months, because they have significant influence for 2 months. Thereafter, it becomes a subsidiary. We must consolidate 100%, 10 months, and for this 10 months consolidated, we must less 20% of NCI share. This is for profit and loss. Profit and loss is for 1 year. At the year end, when we prepare the balance sheets, we must do 100% consolidations, then we must account for 20% of NCI. That's how it affects our financial statements from 30% increase to 80%. For the first 2 months, it's an associate. We use equity method. For the next 10 months, we must do 100% consolidations. Because we consolidate, we have calculate the NCI. At the date of the change, we must calculate the gain or loss on remeasurement of the 30% to fair value. And this gain or loss must be reported in P&L. On the day when the control is obtained, we must take the carrying value minus the fair value, any gain or loss recognized in P&L. So that's the first scenario. Refer to your notes. In the profit and loss, first 2 months, we must use equity method 30% share. From the remaining 10 months, we have to consolidate 100%, then we let NCI share. On the day when there's a gain of control, we must remeasure the 30% to fair value, any gain or loss reported in P&L. This is in the profit and loss. In the balance sheet, at the year end, we have to consolidate 100% assets liability, then we must let NCI share. Calculate goodwill is on the day obtained control, 1st March 2016. Second scenario is that before they have 80%, after that, we increase 10%. Now look at the second scenario. Before that, the parent have 80%. On 1st March, the parent increased 10% equals to 90%. The year end with 90%. 80% give you 100% control, 90% also give us 100% control, which means a control for 1 whole year. If we control for 1 whole year, then we have to account this as a subsidiary for 1 whole year. We must do 100% consolidations. Then we must less NCI. For NCI, we have to be careful. The first 2 months, the NCI is equals to 20%. The next 10 months, the NCI is equals to 10%. We will consolidate as normal, but account for NCI, we just need to be careful. The first 2 months, NCI is equals to 20%. The next 10 months, NCI is equals to 10%. When we prepare the consolidated statement of financial positions, we still do 100% consolidations because we have control. Then at the year end, the NCI is equals to 10%. This is the date of the change. This change do not affect control. We must reduce the NCI. If there's any differences, these differences is not income, not expenses. This will be considered as an equity transactions, will be put back to the equity. For profit and loss is income expenses for the year. For the year, we consolidate 100% for the entire year because of control for entire year. But when you account for NCI, we just need to be careful. The first 2 months NCI is 20%. The next 10 months NCI is 10%. On the date of the change, the increase of 10%, we have to adjust NCI when there's a differences. These differences, just the differences. NCI is considered as equity. If the differences arises from adjusting the equity, the differences will put back to equity. Do not recognize in profit and loss and other comprehensive income. Balance sheet is at the year end. At the year end, we have control. We consolidate 100%. Then we must account for NCI 10%. This is case 2. Case 3, AB owned 80%. On 1st March, AB sold 8%. Now we look at case 3. Case 3 mentioned that before that, AB have 80% in XY. And on 1st March, there's a disposable of 8% equal to 72%. So this 72% will be 72% from 1st March to the year end. This is the date of the change. 80% will give us 100% control. 72% also give 100% control. We have the same control for the entire year. For the entire year, for the profit and loss, XY is considered as a subsidiary. We must do 100% consolidations for the entire year because of control for entire year. But when we count for NCI, we just need to be careful. The first 2 months, the NCI is equals to 20%. For the next 10 months, the NCI will be equals to 28% share. We do 100% consolidation for 1 whole year. But when minus NCI, for the first 2 months, NCI will be equals to 20%. For the next 10 months, NCI will be equals to 28%. And when let NCI share the profits for the year. Balance sheet is at the year end, assets liability. We have to do 100% consolidation of assets liability. And the portion do not belong to the parent. We call this as NCI. At the year, NCI is equal to 28%. This change do not affect control. It affects the ownership of the parent and NCI. For this, we have to adjust the NCI. Adjust NCI, there will be differences. These differences will be recognized in equity directly. Later on, look at how to calculate differences. Case 4. Before that, we have 80%. AB sold 32%, become 48%. Now we look at case 4. Before that, AB have 80%, and AB sold 32%, equals to 48%. For the 10 months is 48%. This is the date of the change. Assuming that less than 50 is loss of control, that's the assumption. For the first 2 months, XY is considered a subsidiary. The profit and loss will be consolidated 100% for the first 2 months. If you consolidate 100% first 2 months, you must let NCI share. In this case, is 20% for the first 2 months. Assuming that on this day, this change resulting loss of control. If it's loss of control, that means for the next 10 months, this may be considered as an associate or financial assets. You have significant influence associate. If it's do not significant influence, it's a financial asset. Assuming now we have significant influence. For the last 10 months, we do not consolidate anymore. We do a 48% share of the profits for the 10 months. On this day of change, we have to do a deconsolidations. We have to consider a step. You must calculate the gain or loss of the 80%. Although only 32% is sold, when there's loss of control, you must calculate the gain or loss of the entire 80%. Referring to the profit and loss, for the first 2 months, we consolidate 100% let NCI share. For the last 10 months, we have to account for the 8% share of the profits if it's an associate using equity method. On the day when the control is lost, calculate the gain or loss on the sales of 32% and the remanagement of the remaining 40%. That means we have to calculate the gain or loss on the 80%. In the balance sheet, at the year end, we must do a deconsolidation on the day when the control is lost. Meaning that at the year end, it's no longer a subsidiary. At the year end, it becomes an associate. This is how it affects the preparation of the consolidated financial statement. The statement of profit and loss and other comprehensive income is for 1 year. For this 1 year, what must we do? Do we add up 1 whole year, or do we add up only a few months, or do we share a few months? The balance sheet is at year end. We have to consider for the 12 months and the year end, what must we do when they involve changes in ownership in subsidiary. Another factor we have to consider is to calculate the gain or loss. Whenever the question asks you to discuss the changes of ownership in subsidiary, if the change resulting gain of control, then your answer will be here. If the change do not affect control, then you can refer to here and use this as your answer. Obviously, you must apply to question. We'll look at how to apply to question later on. For loss of control, this is the point that I must mention. Normally, when loss of control, we have to do deconsolidations. What are the steps to do the deconsolidations? I'll summarise for you here. We're going to use one question to illustrate all this. Please refer to page 48, question 1.1. This question is to discuss the different type of changes of parent interest in subsidiary. Study the questions, understand the issue. We're going to discuss this question shortly. We're going to discuss the detailed step in accounting for various types of changes by preparing the worksheet and consolidation entry. After understanding the process, for Module 11, you must be able to explain the treatments by identifying the type of the changes and the date of the changes, the effect of change, how does this affect control, and the treatment before the change, the treatment at the date of the change, and the treatments after the change. The following are the statement of financial positions of PPL and SSL at 31st December 2016. Simple balance sheet. PPL acquire SSL. PPL acquire SSL through two separate transactions on 1st Jan 2014, 30%, and 1st Jan 2016, 2 years later, 50%. In total is equals to 80%. Total cost of this is equals to 1150. It's over here, 1150. This is the piecemeal acquisition from 1st Jan 2014 to 31st December 2015. PPL only have 30%. Unless the question indicates otherwise, we assume 30% is an associate plus 30% on 1st Jan 2014. 2 years later, this year, acquire 50% on 1st Jan 2016. In total is equals to 80%. We are given the retained earning of SSL at 1st Jan 2014 and 1st Jan 2016. We are also given the fair value net assets at these two dates. Any assets, when they say any assets, there should be assets. Fair value of the net assets over the carrying amount. When the fair value of net assets more than the carrying amount, you have assets. And this assets relating to depreciable plant. The plant have a useful life of 15 years from the date of purchase. If the acquisition is 1st Jan 2009, on 1st Jan 2014, this plant is already used for 5 years. So if already used for 5 years, that means the remaining useful life is 10 years. 2 years later, the remaining useful life will be 8 years. The fair value of PPL previously held interest in SSL at 1st Jan 2016 is 442. This 442 is the fair value of the 30% at 1st Jan 2016. Pay attention to the date. The fair value NCI on 1st Jan 2016 is 295. When parent acquire in total 80%, the 20% is the NCI, is at fair value 295. PPL has significant influence over SSL before obtaining control. PPL have adopted an accounting policy to measure NCI initially at fair value. If the NCI is initially measured at fair value, it means that this is a full goodwill. full goodwill. The question mentioned the 20% is the NCI, is at fair value 295. PPL has significant influence over SSL before obtaining control. PPL have adopted an accounting policy to measure NCI initially at fair value. If the NCI is initially measured at fair value, it means that this is a full goodwill. The question mentioned that the profit of SSL for this year should be adjusted by $10 due to overstatement of net assets. We have to reduce the assets of SSL because assets overstated this year, $10. This will be debited to P&L, $10. With this instruction given to us, we'll just follow the instruction. For part A, we are required to prepare the consolidated statement of financial position at 31st December 2016. We are now at 31st December 2016. We have control at the year end. You have control, you must do 100% consolidations. Then after that, you must do the consolidation adjustment. As usual, you must do the adjustment 1, adjustment 2, and so on. Whenever we talk about adjustment entry, you must have set a working to come out with this set of adjustment entry. I will use the working I normally use. Something like this. The net assets of SSL. Can I refer to this now? First, we must organize the figure, understand the questions. Whether it's a subsidiary or associate at the group level, subsidiary, we consolidate assets liability. Associate, we share the post. We need to know the net assets of this investee at various points. Can we discuss this working here? Net assets of SSL at various dates. Year end is 31st December 2016. The first time PPL acquired SSL is on 1st Jan 2014. This is the date of the investment equals to 30%. On 1st Jan 2016, PPL acquired another 50%, equals to 80%. The first 2 years, 30% only normally represents significant influence. First 2 years is considered as an associate. Associate, we must use equity method of accounting in accordance with HKAS 28. Then after that, 80% will give us control. Control, that means it's a sub-C. Sub-C, we must adopt a full consolidations in accordance with HKFRS 10. The starting point is always at the year end. We need to know the net assets at the year end. How do you calculate net assets at year end? Is equals to assets minus liability equals equity. We need to know what's the equity on this date. First, we look at the share cap. Next, we look at the retained earning. The share cap at the year end, 598. 598. We have to work back onto the very first day when we acquired the 30%. If the question is silent, assume that the share cap now is the share cap 3 years ago. That's a valid assumption unless the question indicates otherwise. How about retained earning? On 1st Jan 2014, the retained earning is equals to 780. And 1st Jan 2016 is 904. Here is 780. This is 904. Share cap remain the same, 500. These are the relevant figure at the relevant point. 30% associate. 30% on the day obtained significant influence. We have to take note of the assets liability of the associate because it affects our share of profits. At this date, the question mentioned that the fair value assets is equals to 1003. Any assets is due to the plant. On this date, the question mentioned that the fair value assets should be equal to 1003. Take this minus this. 500 plus 780 minus 1003. There's a difference of $20. This $20 is the PPSS. We only take note, we do not consolidate because we do not have control, we only have significant influence. After the date obtaining significant influence to last year end, 2 year. What's the profit for this 2 year? Take 780 minus 904 equals to 124. This is the profits for the last 2 year. For this 124, we share 30% because it's an associate. But before we share, we ask ourselves, is there any adjustment for this 124? Yes, because at the date of investment, there's a plant assets. When there's a plant assets, we must also increase the depreciation as a result of the plant assets when we share these profits. The remaining useful life of the plant at this stage is 10 years. 1 year is equals to $2 depreciations. We must account for 2 years. We must account for additional depreciations of $4 when we share these profits. The adjusted profit is 120. For this 120 post profits, it's not consolidated, we share 30% share. The first adjustment entry of the past share of SSL post profits at 31st December 2015. The cost of the associate on the date of investment, 400. This is the cost of the 30%, 400. Share of post adjusted profits. Based on calculation is equals to 120 multiplied 30%. Share 36. After we share, it becomes 436. This represents the carrying value at 31st December 2015. Credit the cost 400. Credit the share. This share is a share for the last 2 years. It affects retained earning brought forwards because the share profit for the last 2 years. Debit investment associate. The 1150 include the 400. And this 400, I just want to take it out and call this as associate 436. This 36 is a share of profits for the last 2 years. Alternatively, you may do the entry something like this. Entry 1, you can simply just add 36 here, add 36 here. It's the same. Inside here, there's a 400. We increase by 36. And this 36 is the share of post profits. Over here, my worksheet, I just want to emphasize. Before this year is an associate. Next, we look at entry number 2. With the acquisition of additional 50% equal to 80%, 80% is considered as a subsidiary. We must do a full consolidations. 3. This is the acquisition date, the date of obtaining control. After that will be considered the post. Again, we know the share cap retained earning. These two added out is the carrying value net assets. For consolidation purposes, we need to know what's the fair value net assets. On 1st Jan 2016, the fair value net assets is 1436. Any assets due to the plant assets. We can put it here. The fair value net assets is equals to 1436. We have to take this minus this. This added out is the carrying value net assets. Compared with the fair value, we have the fair value assets for the plant. There's an assets of 32. This column is very important because this column will be used to calculate goodwill. Number 2, we have to calculate goodwill of SSL at 1st Jan 2016. First step is to take this figure down. Before you obtain control, this is the 30%. Carrying value at 31st December 2015 is 436. This carrying value is relating to the 30%. In accordance to IFRS 3, when you calculate goodwill, we have to take the fair value of the purchase considerations. This 30% we have to adjust to the fair value at the date we obtain control. Go to 442. Over here, 442. That means this 30% is worth 442 on the day obtaining control. The first step is we must increase the 436 minus 442, so there's a plus of $6. This $6 is considered as a gain in profit and loss for the year 2016. Then after that, we have to incorporate the fair value of the 50% at 1st Jan 2016. This is given to us over here, 750 for 50% on 1st Jan 2016. Equals to 750. In total, equals to 1192. It represents the 80% at fair value at the acquisition date. We have to incorporate the 20% of NCI at fair value. According to the question, this is equals to 295. Equals to 295. Then we have to less the fair value of net assets of SSL at the acquisition date. Where do you get this from? From the working that we have earlier on. This will be used to calculate goodwill. Share cap, retained earning. Share cap is equals to 500. The retained earning at the date obtaining control is equal to 904. Plant assets, if it's assets plus, if it's deficit minus, plus 32. Total is equals to 1436. This is our goodwill at acquisition date. 1192 plus 295 minus 1436 equals to a goodwill of 51. If it's a normal business combination, take the fair value of the 80% plus the NCI minus the fair value assets equals to goodwill. This is the formula that we use for the previous sessions. This is in accordance with HKFRS 3. When we talk about business combination, when you calculate goodwill, you must take the fair value cost of control plus the NCI minus fair value assets, differences goodwill. For this question, there's additional step. We must remeasure the carrying value to fair value. This is the additional step when we talk about piecemeal acquisition. If you know how to do this, you should be able to come up with the journal entry. First, you must remove associate. Last year is an associate. The first day of this year, it becomes a subsidiary. Recognize again in P&L on remeasurement to fair value. Eliminate the cost of the 50%. Account for NCI. Eliminate share cap retained earning. Increase the plant, and the difference is the goodwill. This is entry number 2. Can we put this entry number 2 on the worksheet? First, remove the associate, and we have to recognize a gain of $6. We must eliminate the cost of the 50%. We must account for NCI fair value. We must eliminate share capital retained earning at the acquisition date, and we must increase the plant value by 32, and the difference is goodwill. This entry is a very important entry. It's for us to calculate pre-entry. After that is the post. This one is the pre. We have to calculate the post. We need to know what's the post profit for this year. Take 904 minus 998 is equals to 94. When the retained earning increased by 94, we assume this is the profits for the year. This profit for a year will be 100% consolidated because it's a subsidiary, then we let NCI share. We increase the value of the PPE, we must also increase the depreciations. But the remaining useful life for this PPE is 8 years. Let's now say it's 10 years. After 2 years, equals to 8 years. 32 over 8 years, annually the depreciation is 4. Must account for this $4 depreciations. That's entry number 3. Reduce the PPE, increase depreciation, reduce profits. Entry number 4 is to adjust for the error. Entry number 4. The assets of the subsidiary was overstated by $10. Reduce the assets, charge this loss to P&L. Entry number 4. Reduce the assets, debit to P&L. The last entry to account for NCI. Whenever we talk about NCI, we have to go back to the working. minus the $10 error. Well, this is instruction given to us. We add them out, 94 minus 10 minus 4. The adjusted profit for the year is equals to 80. Adjusted. It's consolidated 100%. After that, let NCI share 20%. Entry number 5. Debit profit or loss. Credit the NCI. NCI share 20% of the 80. $16. You just simply need to take out 16 from profit and loss. Transfer to NCI. NCI equal to pre plus post share. Add across. The first entry is to account SSL as an associate. The second set of entries to calculate goodwill of SSL as a subsidiary. Goodwill is equal to 51. Entry number 3 is to account for additional depreciation. Entry number 4 is to adjust for error. Entry number 5 is to let NCI share the adjusted post profits. This column is equals to PPL plus SSL. SSL, we consolidate this 100% 1498. We plus 32, we minus 4, we minus 10. Inside this figure here, we consolidate 100% of SSL. 1498 plus 32 minus 4 minus 10, 1516 of net assets. Also inside here, there's a goodwill relating to SSL, 51. This is the asset liability that we consolidate 100%. How much we do not own? 20%. NCI, 311. The asset liability will include parent plus subsidiary 100%. The portion do not belong to us. We call this as NCI. You must be able to reconcile this figure. 1498, 32 minus 4 minus 10 equals to 1516. But there's another way to reconcile this figure, which I've been doing many times. Refer to the working. From this date, it's a subsidiary add across. 998, we must adjust for error because the question said there's an overstatement of $10 error. At the acquisition date, there's a plant asset of 32, we'll depreciate 4. The plant that you have not depreciated, but to be depreciated over the next 7 years equals to 28. This 28 is relating to the PP. 500 plus 998 minus 10 plus 28. 1516 net assets. This is the figure that we talked about just now. Put this in a diagram. PPL, investment in SSL. The net assets at the acquisition date is equals to 1436. This is the acquisition date. And parent have the 80% must be a fair value. The fair value of the 80% is 1192. The NCI is 295. The fair value asset is 1436. I'm taking this 3 figure out for discussion. So 1192, there's NCI of 20%. So the 20% is equals to 295. 1192 plus 295 minus 1436, goodwill of 51. For this year, there's a profit of $80 after adjustment. When there's a profit, increase the net assets. This increased by $80, NCI share 16. Come to year end, the NCI is equals to 311. After let NCI share 16, the remaining 64 belongs to the parent. This will be 64 plus 1192 equals to 1256. This is the end result for part A. The asset liability consolidated is equals to 1516. The goodwill consolidated is 51. How much do not belong to the parent? 311. How much belong to parent? 1256. Make sure you understand this figure. After understand this figure, then we move on to part B. Part A is talking about piecemeal acquisition. 30% plus 50% equals to 80%. This is what we did just now. Can you look at the notes on this issue? Please refer to page 23. This is what we discussed earlier on. From 30% increase by 50% to 80%. 30, 50, 80. If the question asks you to discuss, you can use the point here. Obviously, when you use the point, you must apply the question. PPL should consolidate SSL from the date when obtained control, which is on 1st Jan 2016. In accordance FS 3, it requires PPL to remeasure the previous interest 30%. 30%, the carrying value is equals to 436. Then we must compare to fair value is 442. There's a difference of $6. This $6 should be recognized as a gain in P&L. Then after that, start to do the normal consolidation calculating goodwill. This is what we did just now. If the question asks you to discuss, you can refer to the point here. But remember, you must apply to the question by showing the company name, using the dates, using the amount. Part A is 30% increased by 50% to 80%. Okay, part B, for each of the case mentioned below, advise the appropriate accounting treatments with journal entry and relevant calculations in PPL separate financial statements and in the consolidated financial statement. PPL acquired another 10%. 80% plus 10% equals to 90%. On 1st Jan 2017 for 170. How this affects the separate financial statement, how this affects the consolidated financial statement. Please refer to answer. Part B, how this affects the separate financial statements, how this affects the consolidated financial statements, which is on 31st December 2016. Now we look at part B. In the financial statements of PPL. In PPL own financial statement, how do you account for this 80%? In PPL separate financial statement, we treat this as investment in share at cost, increase another 10%. It's just buying another assets. In the financial statement PPL, we treat this as investment in share at cost. purchase another 10%. In a separate financial statement PPY, debit investment, credit cash, 170. This balance sheet given to us is on 31st December 2016. What if it's on 1st Jan 2017? In the separate financial statement of PPL, this increased by 170, debit investment, credit cash, 170. At the group level, do we account this as investment? Answer is no. At the group level, we account subsidiary as net assets 1516 consolidated, goodwill 51, the NCI is 311. So in the separate financial statement, we treat this investment, we just increase the investment. But at the group level, what happened to these two? At the group level, increase 10%, 90%. The 80%, 90%, do we have more or less control? Whether it's 80% or 90% ownership, you still have the same 100% control. Do not adjust the assets liability, we adjust NCI. In financial statements of the group, we treat this as business with assets and liability that we control. The control is unaffected. Do not adjust the assets liability, adjust the NCI at the group level. This investment debited at the group level must be eliminated. At the group level, we do not treat subsidiary investment. NCI reduce, debit, NCI. Which figure do we use to do the debit? If the NCI interest drop, we use this figure to calculate. If the parent interest drop, we use this figure to calculate. In this case, NCI interest drop, so we must use this amount to calculate. 311 is equals to 20%. NCI dropped by 10%. 311 dropped by 10. The amount is equals to 155.5. There's a difference of 14.5. NCI is an equity. Now we adjust equity and there's a difference. Do we recognize this in profit and loss? Answer is no. This must recognize directly in equity. You must debit equity directly. Case 1. This entry that I discussed just now. Please refer to page 23. 80% increased by 10% equal to 90%. This change do not affect control. Before that, 80% is 100% control. 90% is also 100% control. Do not adjust the assets liability including goodwill of the subsidiary. Because control the same assets liability, control the same income expenses. We have to adjust the NCI to reflect the changes in the relative interest in the subsidiary. NCI is part of equity. We adjust the NCI means we adjust the equity. As a result, if there's any differences, that's not the differences is equals to 14.5. These differences, the standard say we must recognize directly in equity. If the question asks you to explain, use this to do the explanation. But do not just copy. Instead of subsidiary, must tell the market is SSL, adjust the NCI. NCI in this case is 20%, reduce to 10%. Then you must use the differences, the figure. Do not just simply copy. Use the company name, use the dates, use the figure, use the amount. Earlier on, we say increase from no control to control. There's no impact of control. Assuming PPL dispose 8% of SSL on 1st Jan 2017 for 136. Disposable. 80% minus 8% equal to 72%. Before that, 80% give 100% control. The 72% also give 100% control. If there's no change in control, we treat this as an equity transaction, adjust NCI. Refer to your suggested answer. The second scenario. I'm going to use back the same diagram. B2. The parent sold 8%. How this affects the financial statement of the parent. How this affects financial statement of group. Separate financial statement, we treat this as an investment in share. There's a disposable of investment. It's like disposal of any assets. It's the same like disposal of PP. Debit cash. Dispose for 136. 136. Credit investment. In the financial statement of PPL, this investment is recorded at cost. The cost is 1150. This 150 represents 80% and the parent disposed 8 of the 80% equals to 115. 15 minus 136, there should be a gain of 21. This gain is a gain on disposable investment. We recognize in P&L. If you look at the balance sheet of PPL, reduce this by 115 because dispose. We increase cash by 136. Profit increased by 21. Now we look at the group. At the group level, we treat this assets liability. We control this NCI. How this affects the assets liability control? How this affects NCI? At the group level, we treat this assets liability. We control. The question is that do we still have control? Answer is yes. Whether it's 80% ownership or 72% ownership, we still have the same level of control 100%. We do not adjust the assets liability. Adjust NCI. Increase by 8%. In the financial statements of the group, we consider subsidiary as additional assets liability control. The control is unaffected. We still have the same control. Adjust the NCI. The investment that credited at the company level, you must debit back. If you don't reverse back, when we calculate goodwill, the investment become negative. Just now we calculate goodwill, we use the 1150 to calculate goodwill. The investment that credited, if you don't reverse this 15, when calculate the goodwill, the investment become a negative. At the group level, there's no disposal investment. This disposal investment at the group level, it must be reversed, 115. This gain at the group level, it must reverse as well because there's no gain on disposable at the group level. At the group level, we treat the subsidiary assets liability with control. We have the same assets liability, we have same goodwill, there's no gain or loss should be reported in P&L. To that, you must increase the NCI. Credit NCI, how much to credit? Do we use this figure or this figure to do the adjustment? When the NCI drop, you use this figure to calculate. When the parent interest drop, use this figure to calculate. Now, it's the parent interest drop, so use this figure to calculate. For this question, 80% parent, 20% NCI. Now the parent reduced by 8%. We use this figure to do the calculations, plus 8%. Can I use this figure to do calculation then? It's not wrong, but conceptually it's not right. Let me give you another scenario. What if parent is 100%, NCI 0%? If parent reduced by 8%, NCI increased by 8%, can we use the NCI to do calculation? Definitely not. You can see that when the parent interest drop, we use this amount to do calculation. It's a consistent approach. When the parent interest drop, we use this amount to do calculations. The 80% before change is equals to 1256. 1256 is equals to 80% and drop by 8% is equals to 125.6. Now we have to calculate the difference, 10.4. It's just a difference when we adjust the NCI. These differences will not go to P&L. Whichever figure you use to do the calculations, whether you use the parent or use the NCI to do the calculation, the difference is just the differences. You still have to put back to equity. In this case, this difference is a credit. This credit, do we credit to P&L? No. This is just a difference. You must credit back to equity directly. Do not go through P&L, do not go through OCI. Just credit to your equity back directly. This is B2. We'll look at last scenario. B3. PPL disposed 32% for 518. They sold the 32% for 518. And the remaining 48% have a fair value of 775. Whether it's case 2 or case 3, the treatment will be the same in the separate financial statement. In the separate financial statement, whether the parent is selling 8% or 32%, the parent is selling investment. Whether it's selling 8% or 30%, we calculate the gain or loss recognized in P&L. By the group level, now it's different. Can you refer to your answer here yourself? B3 minus 32 equals to 48. How would this affect the financial statement of the parent? How this affects financial statement of the group? You need to understand the financial statement of parent first, then talk about financial statement of the group. This is the amount that recorded at the company level. And this is the amount that it should be at the group level. How do you adjust from recorded at company level to should be at the group level? In the financial statement of the parent, this is recorded as investment in share. So 32% of the investment, whether it's 32% or 8% is the same. Debit cash, so the 32 for 518. Credit investment, the investment reduced. Before that, the investment is recorded 1150, 80%. It sold 32 of the 80%. 460. Different, 58. This 58 is a gain on disposable of investment at the company level. At the company level, you treat this investment, you sold the investment, you have a gain. So this recognized in P&L. Now we'll talk about group level. At the group level, do we still have control? Unless the question indicates otherwise, assuming there's no more control. If it's a loss of control, then you have to do a deconsolidation. Parent reduced from 80 by 32 to 48. How much NCI? There's no NCI. NCI only arises if you do 100% consolidation. If you do not consolidate, you must de-recognize the NCI. What happened to this 80%? This 80%, this is a carrying value compared to fair value. Any gain or loss recognized in P&L. This is what you need to do when you prepare the group account. Deconsolidate the assets, liability, and goodwill. De-recognize NCI. Compare the carrying value of the 80% to fair value. Any gain or loss reported in P&L. This is what should be at the group level. How do you adjust what it should be, depending on what's recorded? This is whatever recorded. This is what it should be. You have to think about how to adjust from recorded to what it should be. At the group level, there's a loss of control. If you loss of control, you have to do a deconsolidations, account for the gain or loss in profit and loss for the 80%. The first step is we have to reverse this investment. Debit investment is equals to 460. Because if you don't reverse investment when calculate the goodwill for deconsolidations, you'll become negative. This gain is a gain on disposal investment. By the group level, it's not disposal investment. Debit reverse the gain, 58. The remaining of 40%, unless the question indicates otherwise, assume this is an associate. This must be measured at fair value. From the day when the control is lost, it becomes associate. It becomes associate, it must measure at fair value. The fair value of the remaining 40% is 775. This becomes the cost of associate. 775. De-recognize the NCI, take it out. Deconsolidate, de-recognize NCI. Debit the NCI, 311. Deconsolidate this, take it out. Control, consolidate. Loss of control, deconsolidate. Credit the net assets, 1516. Credit the goodwill, 51. Add up this column, there should be a difference of 37. This 37 is a gain. This gain is a gain on loss of control. The 80% at carrying value is equal to 1256 before the control is lost. Compare this with the fair value. So the 32% for 518. Then the 48% we transfer to associate at fair value 775. Total is equals to 1293. 1293 minus 1256. This is the gain of 37. This gain is the gain on remeasurement. This is the working. Use this as working number 6A to do the deconsolidation. With entry 1, 2, 3, 4, 5, in between there's a 6A. I prepare a worksheet over here. Now we are at 1st Jan 2017. Before we look at group account, at the company level, in the separate financial statements, the parent have actually reduced this by 460, and they have sold for 518 with a gain of $58 reported in P&L. This entry is the entry passed at the company level. Over here. Now we have to adjust to the group level. This is the amount that recorded. What is the amount that should be at the group level? At the company level, they've recorded 518 of cash received for the sales of 460 with a gain of 58. Now we look at the group level. At the group level, there's a loss of control. Before we account for loss of control, we must account for consolidation first. This is the entry that we passed earlier on. Entry 1 is to account for associate. Entry number 2 is to calculate the goodwill after remeasurement gain. Number 3 is to account for additional depreciation. Number 4 is to adjust for error. Number 5 is to let NCI share. Now we look at entry number 6. This is the proper step. We do a consolidations. Then after that, we do a deconsolidations when the control is lost. This is the entry we passed earlier on. Let me show to you. At the group level, we must reverse the 460. If you don't reverse the 460, when calculate goodwill, your investment becomes negative. At the group level, must reverse the 58. This 58 is the gain at the company level. At the group level, our gain should be 37. Reverse the 58 and put in 37. Then the remaining 40% becomes investment associate, derecognized NCI, deconsolidate assets, liability, and goodwill. The differences is considered as a gain on the loss of control. Entry number 6A. First, we must reverse the 460, add it back. If you don't add it back, this will become a negative. So we must add it back. Second entry is that we have to reverse this gain, minus 58, reverse the gain. Because at the group level, we say the gain is not 58. The gain at the group level should be 37. Plus 37, that's why the net amount is equals to 21. Then after that, we have to account the remaining 48% as associate. This is the remaining of 48% as associate at fair value. We must deconsolidate the assets liability consolidated with goodwill. Then we must derecognize the NCI. This is the group level after the loss of control. At the group level, the remaining assets is the assets of the parent. At the group level, the remaining 48% become an associate. Subsequently, we share the post-profits. At the group level, the share capitals of the parent, this 2306, 2002, plus the post-profits of 106 equals to 2306. Then, when the control is lost, we must account for gain on loss of control 37. This should be the group level after the control is lost. This should be the correct figure. Proper step, do a consolidations and do a deconsolidations. However, there's another way to achieve this column. This is what the example may do. Look at the second alternative. Another method is we do not consider the subsidiary at all. Just now we add out this 100%, consolidate and deconsolidate. Now we do not consolidate. We still pass the adjustment entry, the same entry we passed earlier on. The difference between method A and method B is, method A we add out this column 100%, method B we do not add out this column at all. If you don't add out this column at all, what should we do? This entry number 6B. This entry is to reverse whatever we have passed. We have credited 400, 750. Now you must have an entry to reverse whatever entry you have passed. This 690 is to take out the 690 from a parent, because the 690 is now become associate. We take out the 690 and transfer to associate. This $18 is to reverse the entry we pass at the group level, and this 775 and become investment associate. This 51 is to reverse the entry we passed earlier on, entry 1 to number 5. The 58 is to reverse the gain at the group level, because at the group level the gain is not 58, the gain should be 37. We take out the 58, we put in the 37. Then this is a post gain shared by the parents. Let me reconcile the 106 for you. What does 106 represent? From 1st Jan 2014 to 31st December 2016 before the control is lost. First, we share the 120, 36. On the day we obtain control, there's a remeasurement gain of $6. This amount will be 100% consolidated. After that, let NCI share 20%. The remaining is the 80% belongs to parent, 64. 36 plus 6 plus 64, the total is 106. This 106 represents the amount of profit we share at the group level, whether it's associate, whether it's subsidiary. Put in the 106, because this is a post profit that we share, then you must take away the NCI. This method A, this method B. Method A is the proper step. You do 100% consolidations, you do the adjustment entry, consolidation, then do a deconsolidations. Method 2 is the shortcut method. We do not add out the subsidiary. The entry that we pass before the loss of control, we reverse. The entry we pass before obtain control, reverse. You can see this and this, at the end of the day, you have the same answer. 238, 238. 775, 775. Share cap 236. Then there's a gain of loss of control 37. You can see that method 1 and method 2, at the end of the day, you get the same answer. This is the proper method.